Well, hello everyone, and welcome to the live Q&A call. This is really nice to have you all here, and as usual, I'll start off with a bit of preamble, talking about what I think is important at the moment, and then we can maybe launch into your questions after that. So, just to start, okay, we're still pretty much in the same situation we've been in for several months now, which is a huge disconnect between the fundamental economics and what's happening to equity markets, which continue to grind upwards. Bit of a sell-off in China today. Even though we had some really strong GDP numbers, we had a 10% fall in the previous quarter in Chinese GDP, and it's gone up 11% in this quarter for Q2 that we just passed. And despite that, equities in China have sold off but it's a fairly large fall. It's about 5%. So that's obviously rattled risk sentiment slightly, but I think that's not a huge sell-off. So I wouldn't worry too much about that. I don't think that's necessarily a tipping point. But this disconnect between fundamental reality of economics and equity persists. The question is how long it's going to continue and how long we're going to continue to see earnings being weak. So that's really going to be the key driver of whether we see the government support overcoming the problems with revenues falling. So I think really it depends on how long this thing continues to see whether we're going to see a larger sell-off. Now, obviously a second wave is also what everyone's talking about. I mean, is it a second wave when the first one hasn't really stopped? Maybe not. I guess it's a question of definition. But obviously, if we do get a second wave, all of the economic forecasts usually have a factor which is the second wave to see how long the impact will last. And generally, the impact is much greater in economic terms if we do get a second wave. So let's just hope that whatever does happen, it does get contained fairly quickly, and we learn from what's already happened in order to learn how to contain it, and also that governments act on that knowledge. Because then I think in terms of the long-term prospects of the equity market, that's going to be a lot better if we do manage to contain it. But anyway, so let's go on to a little bit of admin. So the next live call that we're going to do is on August the 2nd at 8 p.m. UK time. So the usual time corrections for the East Coast and the West Coast of the US. And please do like this. So I will be going through, as we go through the questions, I will be asking you to like the video. And if you are watching the recording afterwards, please do like it. That would be great. And remember that if you do want your question answered and you want to jump to the front of the queue, you can always pay and ask a paid for question, which is called
Super chat.
A super chat. Great. Okay. Okay. Brilliant. So a super chat means that you obviously get answers straight away. And yeah, so let's get started on some of the questions now. And let's start with hi to Zishan. You said you were going to dial in and you did. Thank you for that. Raphael says he's always happy to follow the channel. I learn a lot. I'm 40% invested in European government bonds, all investment grade, some triple B. Do you think there is further upside potential for valuations? Thanks. I guess you're talking here about govies. Okay, so European government bonds, I think, well, all government bonds actually, all developed market government bonds, the key thing to ask yourself is what's happening to risky assets, because that's the primary driver of yields at the moment. And when we see equity markets rallying, you see bond prices fall kind of fairly slowly. But then if we see equity markets tumble very rapidly, then bond markets rise very rapidly. So it is pretty much driven by risk appetite. Good news economically drives equity up and drives bonds down. But at the moment, it seems that almost anything is not going to stop the equity rally. Some people have described it like being like the Terminator. You just can't stop it, right? So it just feels like this it's going to take a lot to derail risk sentiment in this rally. But I think the most important thing for that government bond yields is going to be risk appetite. The secondary concern is the amount of issuance, because obviously we've got a lot of bailout programs and people trying to soften the blow of the crisis by having guarantees for income and also for jobs, which is very important. I think it's important we do that, but it is very expensive and it's usually funded via government debt, and that means more issuance of government bonds. And if that's the case, then more supply, unless there's more demand, which there isn't really. So more supply of government bonds means that the prices go down and the yields go up. So issuance and redemption, which is when bonds mature, those dynamics are very important too, because that controls the supply of government bonds. But I think, probably the most important thing is that and inflation. So if inflation starts to show signs of increasing, that's also bad for government bonds, which aren't inflation linked. So all of that, those are the primary drivers. I'd say risk sentiment is probably the most important at the moment. So is there further upside for German government bonds and European government bonds? Yes, if equity markets sell off. I think that's the key thing. If they don't, then probably they'll be fairly stable. Maybe there'll be an effect of central bank buying as well, because obviously if the European Central Bank is buying, that provides a support for yields and it provides a kind of safety net for government bonds. Oh, we've got a live chat, so let's have a look at that. Mitul Patel, thank you for asking. Super chat. He says, hi Ramin, is there a way of getting access to long volatility funds without the negative carry that you normally get on VIX funds? Okay, that's a good question. Funnily enough, I've written a whole book about it, Mitul, so I do know about this. There is... Okay, let me first of all explain to people who don't know how these VIX products work. What he's referring to is that if you hold one of these VIX products, which links to VIX, which is the fear index, the volatility index in the US, over time, what you find is that the price of it very rapidly drops, always, unless there's a huge crisis in which it spikes upwards. The reason for that is that in order to create that ETN, exchange traded note, what the fund manager does is to buy VIX futures. So these are futures contracts on the VIX, which is the index for fear or volatility. And generally, longer dated VIX contracts have a higher price. Shorter dated have a lower price. So to get exposure, the index provider is always buying the long dated contract, which then loses value because the slope is downwards. And then as it gets closer to maturity, the price comes down, down, down. Then it sells it and it buys the long dated contract again, which is expensive. So you're always trading this difference between the short end of the curve, which you're selling, and the long end of the curve, which you're buying. Now, when there's a crisis, when volatility spikes, the curve inverts. So suddenly everything turns around and the carry becomes positive and the whole curve shifts upwards because volatility increases. So if that's the case, then you get an increase in the value of these VIX exchange traded products across the board. So the part of the curve which you're buying and selling is critically important. So knowing that, and knowing that the carry is usually negative, the clever structurers at these investment houses have said, okay, what we'll do is during normal times when the curve is upward sloping, we'll go short part of the curve and long another part of the curve in order to dynamically reduce the carry cost. So by doing that, during normal times, the carry is slightly negative, so it drops over time slightly, but much less than if you just buy the futures curve and roll down it. So there are things called dynamic VIX products which allow you to do that. So if you look for dynamic VIX, I think you'll be able to find those, Mittal. And if you can't find them, then why not join us on PensionCraft? So you can do that for just $10 a month. You can ask a question on Slack like this one, and then we can chat almost one-to-one. And other people can see the same answer, which the whole community gains from. So $10 a month, you just go to patreon.com/pensioncraft and you can sign up. There's a link in the description below, and there won't be a description above me because we don't have that. Okay, so if you do want to join us, then obviously you can ask that kind of question, and we can send you the tickers, that kind of thing. But obviously in a live thing such as this, that's much more difficult. So they do exist, and you'll have to dig around for the ETF. In the UK, they're much harder to buy. So you can't have these VIX exchange traded products inside a SIP or an ISA. So I would love to buy one at the moment, but I can't. So just be aware of that. Okay, let's go on to a question from Adrian Davis. Hi, Ramin. Do you think investing in gold mining fund and physical gold is doubling up volatility? Yeah, I guess. Okay, so the reasons why you'd buy those two, right? So if you buy a gold tracker like GLD in the US or SGLN in London, then those will be linked directly to the price of gold. The London version will be the price of gold in sterling, which depends on the dollar sterling exchange rate, and GLD in the US obviously will not. It'll just depend on the price of gold in US dollars, which is what everyone quotes. Now, that's a pure gold play. If gold goes up, your fund goes up. If gold goes down, the fund goes down. Now, why would you ever buy miners? Why would you buy gold miners? The interesting way of playing this is the difficulty with gold is that the carry cost, which we just talked about with VIX futures, the carry cost of holding that asset is negative because you have to pay to store gold safely. So it's a wasting asset. It doesn't give you an income. In fact, it costs you to hold it. Now, if that's the case, then how can you get gold exposure but without paying the carry cost? Well, one way to do that is to buy companies that mine gold, because then you'd be buying equity, and if you buy equity shares, those shares will pay you a dividend. So the carry cost is no longer negative. However, because it's an equity, when equity markets sell off, so will the gold stocks, the gold miners, whereas gold tends to rally during an equity market sell-off. So you lose the hedging aspect if you buy gold miners, but you gain the income. So the carry is no longer negative. So it is still exposed to the price of gold. If gold goes up, gold miners go up. If gold goes down, gold miners go down, usually. But the shares will also give you exposure to the broad market. They have beta, to use investment terminology. They've got a fairly high beta, which is correlation to the equity market. So those are the kind of benefits and drawbacks of pure gold versus gold miners. Are they correlated? Yes, because of the correlation to the price of gold. So will they diversify one another? Slightly, because of the beta. So if you had two gold funds, obviously they'd be almost perfectly correlated because both are driven by the price of gold. But if you've got gold miners and gold, physical gold, then not such a high correlation, but still a high correlation. And I don't know what that is off the top of my head. I'd have to calculate it. But would it double up the volatility? It wouldn't double it because the correlation wouldn't be perfect. but it wouldn't be a great diversifier, one of the other or the other. So probably that's what you want. You want either one or the other, if you do want to diversify as much as possible. But it really depends on what else you've got on in your portfolio as well. So, obviously equity is going to be correlated with equity. So if you have miners, they will be correlated with other sectors of equity, almost all sectors, because equity tends to be highly correlated with any other equity. Brilliant. Okay, so I hope that answered your question, Adrian. And David Carr says, "Hi Ramin, good to be joining you this evening. Great to see you here, David." Jenny Leonard says, "Hi Jenny." And Rashmi Wow says, "Hi Ramin, is Vanguard VVAL still a good idea? Lost quite a bit on those. Thanks." Yeah, I mean, any value fund is still seeing a terrible return this year. And in the sell-off, value equities tended to be ones that were hit pretty hard. Things such as momentum have actually done okay, because that's usually equity which is in the tech sector, or for consumer discretionary, which is things like Amazon, right? So those are the sectors which sold off less, and yeah, value just hasn't done well for a long time. Now, if you're contrarian, you do think that, well, this dispersion between value and growth, which are the two opposites. So growth would be things like tech companies, but also small caps, which are growing rapidly, where usually you pay a premium. So those are expensive stocks, the growth stocks. And then value is like the opposite factor. So if one does well, the other one does badly, and they go in opposite directions. And growth has just been by far and away the better bet over the last, well, it's been several years now, almost a decade. So, for 70 years, value outperforms, and then suddenly things reverse. But that's the way factor investing is. You do get long periods of time when your factor will underperform. And it's impossible to tell in a given year beforehand which factor is going to outperform. So if we do see value continuing to underperform, we can't do that forever. There will be a time when it turns around, but nobody knows when that's going to be. So to answer your question, is it now a good idea to buy VVAL? Look, I don't make recommendations, and I don't know when it's going to turn around. What I do know is that it will turn around at some point. You can't get two factors which carry on diverging forever. Otherwise, value stocks would completely disappear in terms of market cap, right? So that just doesn't happen. You do get mean reversion in investment. But do I know when it's going to happen? No. No, I don't. I'm sorry I can't answer that one. Yes, please do like this stream, because if you do, the algorithm will love us and I'll love you. So likes at the moment, we've got 90. We've got 241 concurrent viewers. So that means only about a third of you have liked it, which is such an insult. What can I say? So please do like it and make my day. So we'll see if we can, get a large proportion of you liking this by the end of it. I'll do my very best, more so than usual, in order to ensure that happens, right? So please do like it. And so next question, while I do a bit of product placement, okay. What are your views on factor investing? Which funds available in the UK could I look at to take advantage of this? Well, iShares has a very large range of factor funds, and so does Vanguard. Vanguard has 4 of them. They tend to be fairly cheap. So Vanguard's, I know, are 0.22%. iShares, it varies depending on the fund. Now, my views on factor investing are that it's backed by research. But the difficulty, as we've just said, with factor investing is you never know which factor is going to outperform. And if you choose more than one factor, what you end up doing is diluting your exposure to that factor, the first one. Because generally, factor funds that you can buy as a retail investor, a normal investor, are also highly correlated with the global market, the global equity market. So by buying, what they actually do is what you'll be buying is exposure to the global equity market with a little boost to value stocks. Okay, so if the global equity markets go up and down, so will your fund, your factor fund. Whereas if you're a hedge fund, what you can do is go long, say, cheap stocks and go short expensive stocks, such that if you get the right mixture, you're completely insensitive to global movements of the market. So if MSCI World goes up or down, it doesn't affect your portfolio at all. All that drives your portfolio is whether cheap stocks outperform expensive stocks. So that's a long short portfolio. But usually it's only hedge funds which can do that. You can't do that with a UCITS, EU approved fund, because usually having short exposure is risky, so that's not allowed. So that's why you can't really kind of mix and match these factor funds. So you have to choose one. Which one do you choose? Well, just choose one that you think in this environment will perform well. Do I like them? Yes, I own one. So the one I've got is minimum volatility, VMVL from Vanguard. And I like them because they're based on peer-reviewed research and historical data. So they're evidence-based, rather than paying some fund manager who claims they can outperform, but many of them disappoint and usually cost a lot in the process. So that's why I like, as if you do want to outperform the general market, that's one way to do it, a factor fund. So I do like them. I've done a review of Vanguard factor funds, which you'll find here on YouTube. Right. Please could you explain the difference between a government bond and government gilt and inflation-linked government gilt? Okay. So a government bond is how the government raises money. So if they have less income than they spend, then you have to plug the gap somehow. And the government does that by issuing debt. It does that via an auction. So in the UK, the Debt Management Office does it. In the US Treasury does it via certain market makers which specialize in that, issuance of government debt. And the auction process sets the price of the bond. Usually the coupon on the bond, which is the interest it pays you, will be pretty close to where the maturity is on the yield curve. So let's say that if you look out on the yield curve for the UK government and the 10-year yield is, 1%, then the coupon will probably be close to 1% on the day it's issued. But the key thing is that coupon will be frozen in the bond forever, for the whole life of the bond, for the next 10 years, if it's a 10-year bond. So that's a government bond. It's a way for the government to raise money. And the other type that we talked about was government gilt. So gilts are the name for UK government bonds. Where does the name gilt come from? It's because they used to have a gilt edge on the certificate. And the credit quality is obviously very good for the UK. It hasn't defaulted for a very, very long time. Maybe the war bonds in the Second World War were the last ones to have their maturity extended, I think. So that would be a technical default. But if you don't count those, then you'd have to go way back to see the previous defaults. So the credit quality of the government obviously matters. So if you buy a bond from the Brazilian government or the UK government or the US government, the credit quality is hugely different for different countries. So they also have credit ratings. So the US government, I think, is AAA. I think the UK is AA. Not too sure about that, but it's certainly lower than the US. And then the final one is interesting. It's indexed, so it's inflation-linked gilts. So the idea here is that with a normal gilt, with a normal government bond, if inflation goes up, it's going to hurt the value of your bond. If that's only paying 1% for 10 years and inflation is 2%, then every year, effectively, you'll be losing 1% in real terms. So the buying power of your capital, which you've lended, is eroding over time while it's locked up, and it'll erode quite a lot of value over that 10-year period, more than 10% if inflation's at 1%. So that's why inflation's worrying if you have a normal government bond, or a nominal government bond as they're called. So that's why some people, usually retirees, buy inflation-linked government bonds. Now the idea there is that let's say you lend £100 to the UK government for 10 years. If you buy a nominal government bond, you lend 100, you get a coupon for 10 years, and then you get your £100 paid back after 10 years. With an inflation-linked bond, you lend 100 to the UK government, but then the coupon payments, which you're paid as a result of giving the government your money, will increase at the rate of inflation. And it's usually the government published rate of inflation, usually CPI now, and that'll increase over time because inflation is usually positive unless we get deflation. And then after 10 years, you could get quite a lot more than 100 back because that principal will be inflated at the rate of inflation over that 10-year period. So you can see government bonds, which have been around for a long time, trading at crazy prices for a government bond, like 200 or 300. Government bonds are usually trading at around 100. That's how they're quoted in terms of £100 or $100 chunks. So inflation linked is a way of reducing or actually making zero the risk of inflation. So as I say, retirees care about inflation, so they usually buy inflation-linked bonds. And in fact, the only hedge which works against inflation is inflation-linked bonds. So they're a very important asset class, particularly as you get close to retirement. So really important distinction there. So yes, please do like this channel. And I see 151 of you have now liked it of the 273 concurrent viewers. So still about half. I've got to say, you can do better. You can do better. So please do like it, and let's see if anyone does. What I should do is hold you to ransom. So I should say, I'm not going to go on until we reach 170 likes. In fact, that's exactly what I'm going to do. Oh, okay, we're there. Right, so we'll carry on. Good. Next question. Oh, okay, we've got lots of questions. Okay. Oh, JJ. For those who didn't get questions answered, I would recommend the Patreon membership. I've had whole video explainers posted on the back of my questions asked in Slack. Indeed. So that's the difference. If you go on one of our Sunday evening calls, if you're a Patreon member, it's very likely we'll answer your question because there aren't that many people on the call. And of course it's much less likely on this call. Right, so Chris Knock. Hi Ramin, I want to ask why the price of gold and increased in the past month, but an ETC like Wisdom Tree hasn't. Interesting. I've got no idea why it shouldn't have increased. I mean, if you look at a standard ETN, the only thing I can think of is that sterling has strengthened over the past month. Because if that has happened and the price of gold has gone up in dollars, that would erode, it would reduce from the increase in the price of gold. And I'm guessing, Chris, that you're based in the UK, in which case you would see Wisdom Tree's fund, the exchange traded commodity fund, priced in sterling. So that's the risk as a sterling investor. We see gold in sterling terms, and we have that sterling versus US dollar risk. So I don't know of any sterling hedged gold funds. I mean, that's one way you could get around that problem. But that's the drawback if you invest in commodities in sterling, which is that commodities are not priced in sterling. So I suspect that's the reason, Chris. Any thoughts about the new Vanguard ESG UK fund? Yeah, I like ESG funds, obviously, because, okay, I mean, they have a very basic approach to ethical investing, which is to say, we'll take some parent index, we'll cross out the stuff that's not ethical based on self-reported information from the companies themselves. Now, you could say, if you're cynical, that the companies just have a box ticking exercise where they're sent these ESG questionnaires and, they say, are you ethical? Do you recycle your water? What's your water usage? What's your energy usage? And they might make a kind of nod to ethical investing by changing their behavior slightly, but they may not even tell the truth when they self-report. But at least it's trying to change corporate behavior for the better. Now, what I don't like about it is the actual ethical choices they've made. So, for example, I'm a physicist. I like nuclear power. I like it because it doesn't produce, it's not a fossil fuel, so it doesn't produce CO2 or greenhouse gases, and it uses much less fuel. So I do like nuclear power, but some of them don't invest in nuclear power, for example, or alcohol. Some people don't have an issue with the sale of alcohol, or tobacco, perhaps. I mean, obviously, it's harder to like a tobacco company, but what I'm saying is that not everyone agrees on ethics. So it's very difficult to find a universal set of principles by which everyone will agree is good or bad. But anyway, Vanguard's ESG UK fund, they've actually come out with a whole slew of these for each region, I think, and globally. I think they're great. I think it's a good way and an easy way for people to feel good about how they invest and not to worry too much about what their capital's being used for. So yeah, I like it. If you do want to have more impact, I did a whole video about impact investing. Now, instead of going through an index and crossing names out, which isn't great, you actually positively invest in themes. So it could be green energy, or it could be recycling, or there's a whole bunch of themes which have been agreed by the I think it's a UN which produced this list of ethical themes. And then, you can find a fund which does each of the themes you're interested in. And that way you focus your capital on outcomes, more windmills to generate energy, more recycling, or green projects in order to produce sustainable food, for example. So that's much more focused, and I think has much more impact, as the name would suggest. So I think I prefer impact investing to ESG. But if you can't do impact, then yeah, ESG is good. That's a very long answer to your question. I'm sorry about that. Yes, please do like. Please do like. How are we doing for the likes? 190 of the 292 people. So 100 of you still haven't liked this, which I just can't believe. So please do like it, because it helps us a lot. And if you are watching the replay as well, do please like it and subscribe to our channel, because if you like this, you'll probably like the content that we produce. And why not join us in our membership? There'll be a link in the description below to show how to do that. And then you can join us on our live calls. You can join us on Slack and chat about anything you like with me or other members of the community. It's just $10 a month. Plus you get to support us in producing this content. Okay. Right, I can't pronounce your name. RGRTNYJJC. Is it possible to invest in a SIP alongside an ISA that's been maxed out? Yeah. A very short question, a very short answer. The two are separate, so the SIP limit is not affected by your ISA limit. They're completely independent of each other. The current ISA limit across all the 4 types of ISA is currently 20k per year. The SIP, I think the cap is 40k, or your salary, whichever's the smaller of the two, subject to your lifetime maximum pension, which is 1.1 million. Okay, but the two are separate from one another. Yes, good point. So there's a point referring back to the gold mining question from Jay Atwell, which is that mining companies can also be nationalised. That's absolutely true. And Alex says, hi Ramin, what bond allocation mix you would have as far as duration, percentage of short, medium, long, example percentage of SHY, IEI and TLT. So for those of you that don't know, those 3 ETFs that Alex referred to there, SHY is the short term, IEI is the medium term, and TLT is the long term US Treasury funds from iShares. So if you look at the price action of SHY, it's effectively flat. So short duration government bonds are like cash. They do nothing. You put $1 in, you get $1 out plus a tiny bit of interest. And if equity markets crash, they do nothing. If equity markets rally, they do nothing. Just like cash. Low risk, low return. Intermediate bonds have a bit more volatility. As the yield curve moves around, so this is my yield curve, by the way, short duration, long duration. As it moves around, the price of the bonds fluctuates. And the longer the duration, the more they fluctuate, right? So long duration will be doing this, intermediate duration will be doing this, and short duration would be doing almost nothing, right? So that's the kind of duration risk that you take. Personally, at the moment, I've got a lot of money in, so 40% of my portfolio in long duration UK gilts. Why that? Because firstly, the further out you go on the curve, the bigger the income you get for taking the duration risk. Higher risk, higher return. You're compensated for that duration risk. The second point is that when equity markets sell off, the long duration government bonds increase in value more. So if you look across all of Vanguard's funds and you look at the price change since February the 19th, which is when we were at the peak of the equity market before the market sell-off, the one fund which has done best is long duration UK government bonds. It beats all equity regions, it beats all of the equity funds. It is the best performer. So why did I buy it? Firstly, for capital preservation. Secondly, for negative correlation with equity. So it's an equity hedge. So if equity markets sell off a lot, it'll gain in value. And if that happens, I can always rebalance into equity at a lower price. So just by rebalancing, I'm going to get a big leg up into the equity market. So that's my justification for it. What your justification is depends on your risk appetite. So, for example, I was speaking to someone today who's very, very cautious. And their choice was to go for short duration government bonds because they wanted something that was cash-like, but gives them a bit more interest than cash. So it really depends on where you want to take risk. If you think inflation's about to spike, then the fund which will be impacted least is SHY. But they'll all be impacted to some extent, but the longer duration funds will be hit more by inflation. So really it does depend critically on your views of what's going to happen to inflation, to the equity market, and also these kind of debt issuance and redemption characteristics of the market. But my choice, as I say, long duration at the moment. And Chris says you can invest in a SIP and an ISA. That's true, Chris. Yep. The two are completely separate from one another. New Zealand Anime Manga, NZ Anime Manga says, interesting. Any gold miner ETFs that you know about? Okay, well, let me just share my screen just quickly. I'll just go to ETFDB. And now the reason why I go to this is because I've paid for it, so I may as well use it. It's pretty good. It's pretty basic, but I like it. Let me just share my screen. Okay, so this is ETFDB, and let me just maximize that. Yeah, so this is ETFDB, and we can go to commodity, and we can go to, I think you don't have to pay for this. For this bit, it's free. And I'm going to go for gold. And so GLD is a straight gold fund. But at some point, we're going to see some miners, I'm hoping. Gold Trust. Gold miners. Nope. Okay, so these are actual commodity funds. Let's see if we can search for gold miners. I can if I search. Oh, no. Gold miners. Here we go. So here are some. And here we go. Top 11 gold miners. So ETFDB is great for finding thematic ETFs. So the biggest here is GDX, which is that VanEck gold miners. And the fee for that, let's see if we've got the fee. No, it doesn't have the fee. And the second biggest is GDXJ, another VanEck one, junior gold miners. And we have some leveraged ones, which are probably better off avoiding. And then Ring is iShares MSCI Global Gold Miners. Yeah, so there you go. So there's a whole bunch of them here. Or if you're in the UK, we always go to Just ETF. So Just ETF, let me just minimize that. And you can just search for gold miners. There will be a search here somewhere. And I assume they've got gold miners. Here we go. And here's a bunch of gold miners in the UK. Now what you can notice here is that the expense ratio is pretty high. So 0.65, 0.43. Anything more than about 0.2 is expensive. So the cheapest there is the UBS one, the Solactive Global Pure Gold Miners. Okay. And all of them are in dollars, notice. So you will be taking that currency risk that we discussed earlier. Okay. So back to me. Right. So there are lots of them out there, but really, you know, the expenses are sometimes quite high. So just be aware of that. And also the fact that you're taking equity risk. If the equity markets sell off, so will those. They're not a hedge for equity markets, which gold normally is. Okay, don't forget to like. So currently we only have 219 likes. We have 319 viewers. So there are 100 of you, and you know who you are. You haven't liked it. So please do like it. I'd appreciate it. And obviously it helps us. And oh, you are. Very good. Thank you very much. Great. Right, moving on. Luciana Tavares says, what's the difference between long-term bonds and gilts? And do you think it's better to have inflation-linked ones at this point? So let's have a quick look at the FT, which has a market section which has data in it. So let me just share my screen again. So here we go. Now here, this is the equity bit. We're going to look at the bonds bit. And this is the UK yield curve. So the green line here is the UK yield, which is how much it costs the UK government to borrow for 5 years, 10 years, 15 years, up to 30 years. Now, gilts are, all of these are gilts because they're issued by the UK government, and short duration is here on the left, so that's 1 month UK government bond, and on the right it's a 30-year government bond. And notice how the income, the yield, is higher for the 30-year end than the 3-month or 1 month end. So that's generally the case. It's usually an upward sloping curve. There's a bit of a kink here in it at the moment, the 2 to 5 year bit, but that's quite unusual. And if we look at the US, the yields are generally higher, particularly at the long end. So here you're going to earn 1.3% at the 30-year part of the curve. So that's the difference between short duration and long duration. It's how long you're lending to the US government or the UK government in the case of gilts. So that's how it. That's what I mean by duration. Okay, back to me, and I hope that answered your question. Okay, have I lost it? I think I have lost the questions. Is it still streaming, Laura?
Yeah. Okay. Do you want me to read the question to you?
Yes, please.
Okay. How does the domicile of a fund impact for tax for UK investors? I'm looking at Vanguard. Should I consider an Irish domiciled one to maximise tax benefits?
Maximise tax benefits. So if you do want to worry about, I mean, you should worry about the tax benefits of having a fund which is domiciled in the right place. So is this actually a question about Brexit?
No, I read the whole thing. How does the domicile fund impact for tax for UK investors?
Okay, so the domicile does matter, but if you buy a UK fund which is marketed in the UK, then you do pay. It'll be under the UK tax regime, right? So if you put it inside an ISA, you don't pay capital gains, you don't pay income tax on it, and the same's true of a SIP. So if you put it in a tax efficient wrapper, then you can make sure that you don't have to pay tax on it. If you look up many of these funds on, if you look them up on, for example, Hargreaves Lansdown or AJ Bell, you'll see the fund often has a tick box that says SIP eligible or ISA eligible, which will tell you whether it can be put inside one of those efficient tax wrappers. And what you'll find is that most of them can. And whether they're domiciled in Ireland or Luxembourg, that's still the case, because they'll be traded on the London Stock Exchange and subject to UK regulation. But if you look up on those platforms, you'll see the tick, which means that it's eligible for a tax efficient wrapper. And all of the funds which I buy are in an ISA or a SIP. I never do stuff outside in a general investment account because it just makes the tax situation much more complex, and it's usually not worth it. Okay.
Yeah. What resources would you recommend to someone who wants to become more educated about funds and bonds and creating a portfolio to grow long term? I would say this, but I think our membership is good. I think it's a great way to learn. And the important thing is to learn alongside other people. I think if you're on your own and you're just kind of exposed to markets, there's no way you can learn just by reading. Reading doesn't give you that knowledge. Whereas speaking to other people who are in the same boat helps a huge amount. And also it's useful to have a guide, right? So, I mean, that's what I provide. I kind of have made a lot of the mistakes, and I try and help other people avoid making those mistakes. But really, to learn about funds, I think one thing to do is to buy funds. because once you've bought one, you'll soon learn about the drawbacks and the risks that you have from being exposed to markets. But the most important thing about a fund is that it's just a wrapper for investments. So it's what's inside it which drives its price and its risk. So that's the most important thing to understand, is the asset classes which are inside the fund, because that's what drives the risk and the return on funds. So that's probably the best way to learn, not from a book, but alongside other people, you know, in a community like PensionCraft, which is friendly and helpful, but kind of becoming a day trader just, you know, by watching a video or something like that is probably not a good idea. You really need to get a handle on risk before you kind of make the dive into building a portfolio, for example. Okay?
Is it a good idea to have cash on the sideline at the moment?
Funnily enough, I speak to a lot of people about that very topic. So we talk about cash investing all the time. Now, normally, cash is a terrible idea because cash is guaranteed to have a negative return. So if you decide to invest in cash, normally it would give you much less than a government bond would give you. But at the moment, because yields are so low on government bonds, we were looking at the yield curves just now, because the yield curve is so flat and so low, the actual income you get on bonds is almost zero, which is like cash. So cash isn't such a drawback at the moment. Cash always has a negative, it always has a zero correlation with any other asset because its volatility is zero and its correlation with other assets is also zero, which means that it's a good diversifier for any assets. Kind of like O-neg blood donors or a universal donor for blood. Cash is a universal diversifier for other assets. It always diversifies anything. So it's good from that point of view. But of course the drawback is that it's always going to give you a negative real rate of return. But at certain times, like now, you know, so would government debt. So cash is a good diversifier. It doesn't rally, unlike bonds. If equity markets sell off, it just does nothing. So it has that drawback. But really, I'd say that's the biggest drawback at the moment. Plus, in many countries, it comes with a guarantee from the government. So in the UK, if you have up to 85k in a cash ISA or in a bank account, then the government guarantees it up to that 85k amount, so that if the government, if the bank goes bust, you get your money back. So that kind of safety is very important if you are worried about what's going to happen to banks in this crisis. Okay?
So how risky is it to invest in a tracker for China at the moment?
How risky? Well, I'm back. Okay. How risky is it to invest in a tracker for China? Interesting question, because it's kind of political. Okay, so MSCI actually increased the weighting for China recently over a kind of, I think they did it in 3 phases. So China is now 5% of MSCI global indices. MSCI ACWI, I think it's about 5%. So it is becoming a bigger part of global financial markets. Now, there are some people who I follow on Twitter, which I find really interesting. There's someone called Perth Tolle, Tolle, and she is quite anti just buying an emerging market index, because she says the ethical implications of that are quite negative. So she doesn't like the fact that she sees the Chinese government as repressive, and by buying equity in China, effectively you're giving a nod to that regime. So for many people, when you invest, it is a political thing. Now, one of the drawbacks is that, you know, if you buy a global index, you'll be buying almost everything. So that's why I think ESG funds are interesting. And what Perth Tolle does is she produces indices which she actually ranks different countries by something called a freedom index. Is it subjective? Yes, of course. But it's one reason why some people don't like investing in China. But if you are just talking about the risk of investing in China, Chinese equity is very volatile. And for example, in 2015, the government was telling people to go out and buy Chinese stocks, and they did. And then very quickly, we got a huge spike in Chinese equity, and then it crashed. And that's been happening again this week, right? We've had the Chinese government telling people to buy stocks, and they did. And, today we saw a sell-off. It's not clear how much that's going to continue, but there's also the question of governance. And if you listen to Muddy Waters, and there's a Netflix documentary about Muddy Waters, which I strongly recommend, watched it recently, there is this question of how accurate their accounting data is. And some of the companies have just been completely lying about their income. Is it just China that does that? No, obviously it happens in the West as well. But I think the governance is much tighter, and at least the regulation is much tighter in developed markets than it is in China. So these are all the concerns, right? Governance controls, the correctness of the data which is published, and the ethical implications of investing in China. And for example, I made a video about investing in China. How do you get exposure? I thought it was quite basic. I just thought, well, I'd list some of the ETFs. And I got quite a few comments saying, why are you talking about investing in China? It's not ethical and so on. So many people feel very strongly about this. So you have to kind of question yourself, are you happy with that? Personally, I am. I am willing to invest in China. I think the best way to change a regime is by being engaged with the regime, rather than trying to cut off capital. And I just don't think that's such a such a kind of powerful way of changing things. I think by giving capital, or at least giving the capital in a conditional way, which is probably what MSCI is doing, they will cut the weightings again, I suspect, if there aren't improvements in governance in China. So I think the best way to do it is to engage rather than cut off capital. But really, that's a subjective thing. You've got to decide that yourself. Okay, I saw a 7up comment. This stream is sponsored by 7up by Charles Chernobyl. Very good. Yes, indeed. If only it was. So, likes 247. Again, we're short by 100. 348 concurrent viewers now, and still only 247 likes. So who are these people? The 100 people who have not liked the channel. Please do like this stream. It's very easy. You just click on like, and I'm going to have to go quiet again. Don't make me do it. I'm going to have to go quiet again. I'll have to wait till 260 now. So we're at 252. 258. 261. Okay, there we go. So somebody says they're communists, so any investment could be seized. Well, I think, China is unlikely to turn away capital, because by opening their markets, effectively what they've done is made it much easier for their own companies to develop, because they have much easier access to a very broad pool of capital now. So I think it's very unlikely that they'd seize the assets of their own companies. So I think it's unlikely, but possible, I guess. There does seem to be higher interest than usual in ethical investing, Elchris 9K says. Yeah, I've noticed it too. There definitely seems to be an increased interest in ESG. I've noticed that. Bruce Wayne, really? Cool. if I invest 10,000 and it turns to 50,000 in 5 years and the brokerage fails, does the FSCS cover 10,000 or 50,000? Okay. And it turns to 50,000, and the brokerage failed, does it, the FSCS cover 10,000? Okay, for 50,000, I guess. So the rules which apply to brokers are that they have to keep their money. They have to keep their money separate from your money. So it's called money segregation. And that way, if they go bankrupt, they don't have a claim to your capital if it's regulated in the UK. So that protects your money. There's an 85k limit for the protection from the Financial Services Compensation Scheme in the UK. So I've done a whole article about that. If you Google PensionCraft, FSCS, that's a Financial Services Compensation Scheme protection, it'll pull up that article, which kind of explains how it works. And we've also got a frequently asked question in our frequently asked question document for PensionCraft community members, which talks about that in quite a bit of detail. So do have a look at that. Mate G says it's great you share your personal opinion. Great. Okay. Okay, yep. So Bruce Wayne says, oh, it's an answer to Bruce Wayne. Up to 85k value, as far as I understand, it's not the original amount invested. Yeah, that's right. Done. Do you think buy-to-let is a viable strategy for your pension pot? No, I don't really like buy-to-let as an investment, particularly at the moment, because certainly in the UK there seems to be the idea that property always beats equity investments. If you look at the Dimson Marsh Staunton data, which goes back to 1910, they show that that's not the case. Usually equity, or at least historically, equity markets have given you better returns than the property market. So that's why probably you'd be better off investing in the equity market. And the big drawbacks with property are, firstly, that you have to fix someone's boiler at 2 a.m. in your underpants. The second problem is that it's very illiquid. It can take a very long time to sell a property. I know because I've just sold one. It can take months, sometimes years. And if there's a downturn, it can take even longer. The market becomes less liquid and you have to drop the price. So you have this huge concentration risk because you're exposed to just one country. I mean, if you could buy a portfolio of property across the world, then you'd be diversified. But usually you buy in the country you live in, so you're exposed to that country's GDP very heavily. So that's why I don't like it, because of the illiquidity, the exposure, the concentration risk, and the fact you have to invest a huge amount, because as a proportion of most people's portfolios, the amount you have to invest in property is very big. Whereas with a share, you only have to invest 100, if that. Some shares are even cheaper. So I don't really like it as a portfolio. I don't consider it part of a portfolio. If you are going to buy real estate, probably something like a REIT, a real estate investment trust, would be a better way of doing it. But again, you'd have to think about diversification. It trades much like a equity, so it's very risky. In fact, it's even riskier than equity. So, if you are going to do it, probably REITs are the best way to do it, I think, because that's a kind of proper liquid asset class. Okay, I think the people who did not like are Coke drinkers. Well, funnily enough, I also drink Diet Coke, so I should say Coke Zero. That's my favourite. So all of the Coke people out there, I do like Coke. So please do like it. 282 likes, 380 concurrent viewers. And I see that Coca-Cola comment just lost one viewer. There we go. Right, so do like it, please. That would be great if you did. because it helps us a great deal. Subscribe to us if you're not already, because then you can watch our future videos. You'll know when they're published. And yes, join our community. There'll be a link in the description below which tells you how to join us. It's on Patreon, patreon.com/pensioncraft. And it's just $10 a month.
Last question.
One more question. This is it. Okay. I shall choose carefully. Okay. What do you think of synthetic ETFs for a long-term portfolio? Are there serious dangers still after the newer regulations? So let's just explain what a synthetic ETF is. A normal ETF, an exchange-traded fund, people pool their money, so they buy the ETF, thousands of people buy it. That money flows into a big pot, which the fund manager then invests into some index. So let's say it's a S&P 500 tracker. They buy stocks in the S&P 500. How much would they buy? Well, Apple, they'd buy 3%. Microsoft, they'd buy 2.9%, or whatever the weights are for the S&P 500. So by doing that, they copy the returns of the S&P 500. With a synthetic ETF, it's a bit different. The money flows into the pot, just like it did before. But what the fund manager does is to buy a derivative which is linked to the S&P 500. That could be an S&P 500 future, a futures contract, or multiple futures contracts probably. It could be a total return swap. So there are various derivatives which track an index perfectly. So the benefit of a synthetic ETF is that the tracking error, the deviation between the fund's value and the index, is zero, or very, very close to zero. The drawback is that the derivative has to be bought from a bank, so you have counterparty risk, and if the bank goes down, so does the ETF. So that's the risk. So by buying the physical assets, it's much safer than having a synthetic ETF. And in this kind of environment of a crisis, people are worried about counterparty risk. Banks are still well capitalized, but will they still be well capitalized once loans start defaulting, which they're starting to do now, right? So that's the worry. Are there still dangers with the new regulations? Yes. Banks could still become bankrupt. So if you buy, I'm just saying randomly here, an example, if you buy a derivative from Deutsche Bank, a total return swap from Deutsche Bank, you're taking their credit risk. So your product, your ETF, will have that credit risk. So is it risky? Yeah, it is risky. Oh, and I see Warren Buffett's a big Coke fan. I knew that. Okay. Anyway, so I hope that was useful. Please do join us on Sunday, the 2nd of August at 8 p.m. UK time, which is going to be our next call like this on YouTube. And then please do like it. There's still time. There's still time. There are still 372 viewers and only 291 likes. Unbelievably. And yeah, I think that's great. Thank you all for your time. And do join us on Patreon. It's $10 a month. Link in the description below. And we'd love to have you as part of the community. We've already had some people in the chat say how much they like being part of the community. So do join us, and I look forward to seeing you again, and hopefully on Patreon as part of our community. So take care, everyone. Have a great 2 weeks, and see you in 2 weeks or possibly sooner.